Okay, let's do something a little bit different today. If you're a homeowner, you're a home buyer watching rates, what do you think the Federal Reserve's going to do at tomorrow's meeting? Yeah, the Federal Reserve's come out tomorrow, and they're going to say if they're going to cut rates or not. So I'm going to give you all the information that they look at, and then at the end of this video, you let me know down below what you would do. So folks, my name is Dan Frio. I'm actually a licensed mortgage loan officer in all 50 states, as well as Puerto Rico. My goal each day is to come in and explain to you guys what next going on with those and why. So today we're going to talk about this thing right through here. The Federal Reserve, what do they look at to set rates? Well, they look at things like inflation, the PCE. I watch the CPI, but it's kind of the same thing. And then the unemployment numbers and also the GDP. And why I'm saying this is we got one last piece of information today, and yeah, I'm going to be a little sarcastic on this, and it's coming from ADP payroll report. So you guys know how I feel about this. But over through here, ADP came out just this morning and said there was 7.75 thousand new jobs created last week. Well, the last reading was 8,000. So it's not great, but it's not falling off a cliff. So that's the last piece of information we have. So let's now composite all the stuff that you'd be analyzing to figure out what you would do. Would you cut rates or would you not? Let me explain what they do. So they look at inflation to see, okay, they want this thing to be at 2%. We're above it. So they're saying, okay, well, maybe we can skip past this as long as the jobs market is deteriorating. Well, the jobs market doesn't seem to be falling off a cliff. So let me give you the data so you guys can decide. So what I did is I scanned the universe and here's what I got. So the indicators they look at is the unemployment rate. That's the first thing we're going to look at. In January of 2025, a year ago, the unemployment rate was 4. Right now it's 4.4. Just so you know, the Federal Reserve was created for really two mandates. One was to keep jobs at full employment, and one was to keep the inflation in check. Well, anything under 5% is full employment. So it did tick up, but it's still, I guess I'll say okay. The CPI is inflation on the consumer level. That's the C in the front of that. So it's consumer inflation. There's also a PPI that would be producer inflation. The consumer inflation, January of 2025, we started out at 3. Now this is where both these numbers, they want at 2. It's at 2.7. Okay, so it's still elevated. So you're sitting there saying, okay, we're not at that threshold of 2, but here's what they really watch, the PCE. It's similar to the CPI, but it has different components. At the beginning of January of 2025, it was 2.6, now we're at 2.8. But you gotta remember, tariffs are built into this. So remember, they thought, okay, this could be 3, 4, 5, 6%. We don't know because of tariffs. Well, it didn't really fall off a cliff. So based on this information, what would you do? Well, the analysts over at CNBC said there's going to be 2 cuts this year. Now, this is the survey that they came in with. And they said there's going to be total of 50 basis points. That's 0.5%. So they're saying that they're going to cut 2 times. Well, if you go over to here, the markets are telling us, well, there's a 97% chance that they're not going to cut at this meeting. There's an 86% chance they're not going to cut at the next meeting after that. And there's almost a 75% chance they're not going to cut after that. So what are your thoughts out there? Well, let me give you my thoughts on this. So for that, let's get over to the bond market, and then I'll kind of take a little bit of a deeper dive into this. So the first thing I want to say is inflation. Yeah, it's a little bit higher than expected. I even said there's going to be a January effect, which would be a lot of manufacturers pushing their tariff increases to the public and our country, basically in January and February. We're also going to get the stimulus checks because of the big, beautiful tax bill. That's going to put a little bit more money in people's pockets. They're going to spend it. So short term, we're probably going to see a little bit higher bump in inflation. That's my call. And so I'm going to say the Federal Reserve is not going to do anything because, don't get too excited, the inflation is going to go up. Then between oil, housing, and then once those tariffs kind of really go into effect and sit there, you're going to see inflation topple. Okay, so that's my prediction there. Now, on the unemployment side, I think AI, attrition, and a whole bunch of other things is just going to stabilize the markets. Once everything kind of just comes stable, whenever that may be, and is it even possible in today's world, you're going to see basically companies finally saying, okay, now we can get back to normal. So that's my thought process. I don't think the markets are going to crumble. I think we might have a little correction here. I think things are a little bit frothy, but let's get over to the stock market to see what it's doing. But let's go over this real quick. This is what we follow when we're trying to figure out what's going on with mortgage rates. This is a mortgage bond, so why would you follow anything else? So what you see up there is a bond price that says 101.41. What the heck does that mean? Well, all you have to understand is this. If the bond price over there is going up, rates are coming down. There's kind of a yin-yang effect. Here's how it works. I do this kind of once a month, and I'll show you how paying a higher price for a bond, in this case it's a mortgage bond, how it actually brings down the yield. And that's exactly what the Federal Reserve did back in 2020, 2021 to basically bring mortgage rates down. They came in and started buying $40 billion of these bonds each month. So here's how it works. Let's say a mortgage bond, the face value is worth $100. So whoever's holding that bond at maturity, they're going to get $100. So I'm going to say, for simplistic reasons, I gave you $50 when I invested in this bond, and now today it comes to maturity. So I bring it to you, my $50 bond I paid for, but remember, it has a maturity price of $100. So I give it to you. I paid $50. You give me my $100 back because that's a coupon price. So I doubled my money. So now here's what I want to show you. I'm now going to pay you $100 for that. And you're probably thinking, Dan, that makes no sense. Okay, but let me explain this. As the price goes up, yields come down. So I paid you $100 back then for that bond. You gave me the bond. Now today I give you that bond back and you give me my $100 back. So what's my yield now? 0. So you see at 50, we were at 100% yield. At 100, we're at a 0% yield. I hope that makes sense. And because it's a mortgage bond, that means my mortgage rate or my mortgage yield changed. That's how that works. So based on this, let's see what the markets are doing, the bond markets and the stock markets. And we go over this each day. We got pretty good news going on in the NASDAQ today. We have the Dow Jones tumbling right now, and that's because of United Healthcare. There's some issues with their stock today, and it's basically pulling that the whole Dow Jones down right now. So if you take that out, it'd be kind of net neutral in the Dow. S&P, NASDAQ, and oil both up. I don't like oil at $61. Guys, I like this at 60 or below, and we also have the 10-year Treasury behind me. Let's finish our day to see where crypto is, and crypto's in the green when you're looking at Bitcoin. So now what's my expectations of where things are going to be short-term, mid-term, and long-term? So let's look at it this way. If you're a homeowner right now and you have a rate at 7% or higher, what should you do? You should go right through here. This is the rate update. This is my website. So folks, my name is Dan Frio. I'm actually a licensed mortgage loan officer in all 50 states as well as Puerto Rico. I've been doing this for over 35 years. I'd love to help you. My slogan is this. I created this thing. It's one application, one credit pull. We're going to shop your loan to over 30 different lenders. How? Why? Well, here's what I do. I take your application, we get you approved because I'm a lender. My bank provides me licensing with all these states, and I'll get you approved. But then my company, my bank, is set up with over 30 different lenders. Why? When you call in, what are you looking for? You want the most product availability you have. You want the lowest rate and the lowest fees. Well, that's what we hope to do here because we're going to use your one application, one credit to search over 30 different lenders to find that lowest rate and lowest fees for you. So if you want to tackle this on your own, go ahead. But I got a tool right up there to do that for you. It's called RateWatch 2.1. Put in your mortgage information in there. I monitor it. I put in AI there. I don't want that to scare you. I monitor this every day. And when rates hit exactly where you want to refinance, or if there's a big enough savings for you, you can even put that in there. So if your savings hits a certain amount, I'll reach out to you. So fill in your information. If you already got a quote from somebody, please upload your loan estimate right into there. We can review that with over 30 different lenders. But what's my thoughts going down the pike? So I don't think the Federal Reserve is going to do anything at this meeting. Unless the news gets worse, I don't really think they're going to do anything at the Ford meetings going down the pike. So here's the advice I got for you. If you're a homeowner and your rate's over 7, please reach out to us. We can go over the numbers, what your new payment would be, what the cost would be, and what your break-even point would be. And that's what I would say. So if there's a savings there, lock in. Okay, even if you're closing within 30 days, lock in because don't go through all this volatility because mortgage rates, they might come down and they're going to come down gradually. But if they go up, they're going to go up with jumps. So be careful and lock in that loan rate now. Now, let's say you're going to buy in the spring or build later on in the year. I don't think you're going to have that much to worry about. You're going to have a whole new cast of characters at the Federal Reserve because we're going to have a new Fed president. Then we're going to have 1 or 2 maybe other new members, and they're all going to be appointed by Trump. So you know which direction they're going to go. So I don't really think things are going to go really anywhere. I don't think inflation's going to spike because of tariffs or anything else. And I don't think the jobs market's going to fall off a cliff. So my expectations are I'm still going to go back to this. I'm saying my prediction for Q1 of this year is going to be rates at 5.875 to 6.25. And we are right there in the wheelhouse there. So you might see this tick up a little bit or a little bit down each day. That's what I'm saying, lock in. But if you want to get pre-approved, and yes, I said pre-approved, if you're looking to buy or build, please reach out to us. We have over 30 different lenders that we work with. We also are a bank. So we have all of our products, and also you won't be able to beat our pricing when it comes to rates and fees. So check out our website. Make sure you check out and subscribe down over there. I got over 6,000 videos. You believe that? I got over 6,000 videos to help you understand a little bit more. If you're a homeowner, should you refinance? Maybe you're a home buyer. What programs are available for you? Or you're a realtor or a loan officer trying to explain to your clients what the heck are going on with those and why. So thanks for watching today, folks. I will be back at the closing bell to let you know how this mess ends for the day. Other than that, have a fantastic day. And if you need some help with a mortgage, please reach out to us. We would love to help. Stay warm out there. It is minus, I think, about 20 degrees here in Chicago. So stay warm, folks. I'll see you at the closing bell. Take care. Bye-bye.